In this video, I'm going to give you the strategy that I wish I knew as a beginner, and this is a fantastic model and probably the easiest strategy in all of trading. Right? I spent years learning how to trade, and I've condensed it into the simplest model I think is possible. And you only need one time frame, although daily buys will help, but you only need one time frame for this model. And it works in all sessions: Asia, London, New York, and I'm going to give you an example on each. Okay, so the first thing you're going to do is you're going to zoom out and you look for the higher time frame trend. And it's pretty clear that we're bearish, right? So you've essentially got your bias, and this is like a cheap and easy way of determining the daily bias. Now, obviously, if you're on a daily chart and the 4-hour chart, you can get more precise with your entries and the bias. But just in case you struggle with it, you can always just zoom out on the 15-minute chart and get the overall trend, right? So we know we're bearish and we're only going to look for shorts. Now, what are we going to do next? We always talk about this. What we're going to do next is we're going to look for a liquidity sweep, right? We always wait for liquidity sweep, and a liquidity sweep is just, in this case, because we're bearish, we're waiting for some sort of high to be taken out. Right here is London's high. So let's mark this out, right? Right here is London's high. Right, so we've got London's high. Price comes in during New York. It takes out this high, right? It wicks through it, and it instantly reverses. It instantly reverses in the opposite direction. And we always want to see this. So we've had our London high liquidity sweep. And it doesn't have to be London's high. It can be any high, because this works on all sessions. But you want to see some sort of key high taken out when you're bearish, and price quickly to reverse in the opposite direction. And as always, we know it's a liquidity sweep because price has wicked through it, right? Because we've wicked through it and then instantly reversed. That tells us it's a liquidity sweep. Now, if price did something like this, right? If price went through it and the body closed massively like that, right? And then started to come down, that's not really a liquidity sweep, right? It's not really a liquidity sweep because it's very strong. But because we have a wick, shoots up, takes up the high, instantly reverses, that right there tells us it's essentially just fake move, right? And this is something for your notes. When you see these long wicks, right, on both sides, they're usually just stop runs, right? If you look very carefully, this is just Asia's high getting taken out on the 15-minute chart, and then this is London's high getting taken out during New York. So these wicks tend to usually just be stop runs. Again, you've got this one here, so you've got lots of highs here. This wick here is just to take out highs. So the wicks are usually stop runs, but the body is the meat of the move. So we've had our liquidity sweep, right? We've taken out a high, in this case London's high. The next thing we're looking for is we're just looking for a bearish fair value gap to form, right? A bearish fair value gap to form. And remember, we're on the 15-minute chart, because everything on the 15-minute chart is so much more significant, right, compared to the 5-minute chart, because each candle is just 3 5-minute candles put together. And what that means is that smart money traders who trade, let's say, who are day traders, they're going to look at the 15-minute chart, because the 15-minute chart will tell you everything you need to know. And because there's only so many candles that will get printed during a key session on the 15-minute chart, there isn't much time for lots of liquidity sweeps. You might see this sometimes on the 5-minute chart where this is a liquidity sweep, or it might just be a high. Price might come up, take out again, and then go down, right? It has a lot of messing around, right? You could take out this high and then go back down. A lot of messing around on the 5-minute, especially the 1-minute chart. But on the 15-minute chart, everything's so clean. So we know we've had our liquidity sweep, we know we're bearish, and now we're just looking for our entry. We're just looking for our entry, and here you've got your big fair value gap. Now, I just enter at the low of the fair value gap when I'm bearish. Now, you can enter at the midpoint if you really wanted to, but the key thing is you just want to get into the trade. We've done all the hard work. And for take profit, you're going to target at least, I always say a 2-to-1. Always target at least a 2-to-1. But for me, and I hope it's quite clear, this low here, right, has lots of liquidity. So let's just zoom out a bit. This low here has lots of liquidity, and it's actually the previous day's low. Because on the 15-minute chart, we can see the previous day's low and high here. So we mark this out. This low here, lots of liquidity. Lots of liquidity. So realistically, you want to target the opposing liquidity pool, right? Because that gives you just a better risk to reward ratio, and you get almost a 2.5 risk to reward ratio. So a nice, easy, high probability trade. I'm going to give you another example, but this time it's going to be during London. Okay, so we're back onto London session here, and this move right here, it's a liquidity sweep, but it's also a fake move, and it's so important that you understand this, because London will always have a fake move, right? And this is when sessions play a big part in it. If you trade New York, it's usually a continuation of London. If you trade London, there's always a fake move in the opposite direction of the bias. There's always a fake move in the opposite direction of the bias, and then price starts to move in the real direction. And this fake move is essentially a liquidity sweep. And that's what it really is. It's a liquidity sweep, and it's taking out highs here. I know we've not really got many highs here because Euro's been dropping, but this right here is a fake move, right? It's a fake move designed to get retail traders to start buying and chasing price up, right? And you do want to ignore that, right? And this is why we always look for the trend on the higher time frames, or in this case, the 15-minute chart, because we want to make sure we're on the right side of the market. Because if you didn't know about, the bias, you might have bought this fair value gap here, right? We mark this out. You might have bought this fair value gap here and targeted these highs up here. You might say, oh, this is almost relative equal highs. because we've zoomed out on the higher time frames, we know we're bearish. We're not going to fall for any of that, right? We're only looking to get short. Okay, so we've had our fake move up, and we're expecting this because we know it's London, and we know London tends to make a fake move, right? Whereas with New York, we were just looking for any sort of liquidity sweep. We were just looking for, let's say this was the high. We were looking for a little wick to point above that high and then quickly reverse. But because it's London, we're expecting a fake move, right? A whole fake move up, and that's essentially your liquidity sweep. And it acts like the liquidity sweep. And now at this point here, we're looking for any sort of bearish fair value gap, right? Because we just want to follow the trend. And we've got this big bearish fair value gap right here. So let's mark it out like that, right? Like this. And what we're going to do is we're going to look for any reason to get short, or any entry to get short. And this is so important, right? So we get two entries here. We get one entry right here and another one here. And this is why I'm a big believer in just taking the easiest entry possible, right? Because this right here is the easiest entry possible. Just taking the lower the fair value gap when you're bearish. Lots of people will try and finesse the entries, and they'll try and enter at the midpoint or even the order block, which is just the last up close candle, followed down. They just try and get, you know, the maximum risk reward they can get. You don't need that. And if you do that, a lot of the time you're going to get this, where price hits the fair value gap and then goes off without you. And it's very, very frustrating when you do that. So just take the easiest entry possible like that. And I'm telling you, all you really need is a 2-to-1 to be profitable. If you can get a 2 risk reward ratio, you can be profitable with that. But nevertheless, we're going to zoom out here and we're going to look for the next obvious liquidity pool. I hope it's pretty obvious. Here, this low here, the previous day's low. Lots of liquidity at this. Lots of liquidity at this low here. And if you do that, you get 2.5 risk to reward ratio. A nice, easy, very high probability setup that you can just take short in this. And it's much better to get this consistently, you know, these 2 or 3 risk to reward ratios, than to very rarely, let's say once every few weeks, get a trade that, you know, comes all the way up and you can finesse it with a really tight stop loss and it goes to your take profit. Because most of the time, what you're going to get, or what you're going to see, is just price do this, right? It's going to come up, and let's say your entry was all the way up here. Price is going to come up, going to hit the fair value gap, and it's going to go straight off without you. Straight up without you. And you're going to miss so many good setups. You're going to do all the hard work, but you're going to miss out and not make any money because you're trying to aim for like the highest risk to reward possible. Now you can, if you really wanted to here, let's just remove this arrow. If you really wanted to, let's say you had your normal entry, is that you could target a 3 risk to reward ratio because you're on the 15-minute chart. And because you're on the 15-minute chart, it's another thing I like about it, is that you can kind of get a better risk to reward ratio because it's such a larger move, right? It's such a large move. Because just zoom out here, you can just see like all these big moves here. We're capturing, you know, large moves. We're not looking for little tiny scalping and, you know, little tiny scalping moves. We're looking for big day trading moves, big real moves. This is the real meat of the move of the day, right? Same here. You've got large displacement downwards, and we just want to capture that consistently and consistently, because that's what day trading really is. That's what profitable day trading really is. Okay, so for this example, we're on New Zealand dollar, and we're also in Asia, right? So this is Asia. So I know a lot of you trade Asia. So this is a profitable Asia trading strategy too. And what we're going to do, as always, is I'm going to zoom out. We'll look for the higher time frame trend, right? Pretty obvious, we're bearish. So we're only look for shorts. We're not going to long in any of this. We're going to look for shorts, right? So now we're going to get into lower time frames, and we're in Asia. So Asia starts around 8 p.m. Literally right here, 8 p.m. Eastern, and we're going to look for a liquidity sweep. And because we're bearish, we're looking for any sort of high to be taken out. And I hope it's pretty obvious. Lots of liquidity here at this high right here. So let's mark this out. Right, so you've got your liquidity sweep here. This is just a fake move. Price comes up, takes out the high, and then starts to reverse. And for those of you who are really eagle-eyed, you might see this right here. So this gap between these two candles, you see how the wicks here, only the wicks cover it, and not the bodies. That right there is what you call a volume imbalance, right? It's called a volume imbalance. Now, you don't need to know this, but, you know, if I was on the charts, it just adds to the probability. And this volume imbalance here essentially acts as a fair value gap, right? Just as a fair value gap where price comes into it and then reverses. That's what this really is. But again, it's very high probability because prices, we've had the liquidity sweep, it touches the volume imbalance and then starts to move down. But yeah, you don't need to see a volume imbalance at all. It just adds to the probability. And if you know what a volume imbalance is, by all means, you know, just add it to your analysis if it's there, but, you know, you don't need it at all. A fair value gap is a lot more important than this volume imbalance. So let's just remove this now. So we've had our liquidity sweep. We know the bias is bearish. We're looking for any reason to get onto the trend, and we're looking for a bearish fair value gap to fall, and we get one right here. So let's mark out this fair value gap right here. Here's your bearish fair value gap on the 15-minute chart. So this is very significant, and we're just going to take the easiest short possible. So we're going to short right here, stop loss at liquidity sweep high. I always say this, the reason we put it at liquidity sweep high, for those who keep asking, is that price, very unlikely, come up and take out this high. If this high was a real liquidity sweep that took out this high, very unlikely that price will come up, take it out again, and then start reversing. Very, very unlikely that's going to happen, especially if you're a day trader, because the sessions are so short, or relatively short, especially on the 15-minute chart as well, right? Because you've got the 15-minute chart, there's less messing around. And when I say messing around, I mean liquidity sweeps, because that's what messing around really is. It's just liquidity sweeps, because everyone knows the buyers, right? Everyone knows to get short, but putting your stop loss in the right area, right place, and getting your take profit in the right place, that's the hard part about trading. The bias is pretty easy, right? You just zoom out and look for the trend. It's pretty easy, but yeah, so that's the reason we put our stop loss here. Nice and safe, because we had the liquidity sweep. In terms of take profit, obviously always target at least a 2 to 1, but for me, it's just very obvious that we're going to go for this low. Maybe it's just my eyes see it, but we've got almost relative equal lows here. We haven't really got any order block that's respected. Quite obvious, low-hanging fruit, so to speak, right? So here, you get almost a 3 to 1. So if you really want to aim for a 3 to 1, this could be a trade that you could do a 3 to 1 for. Nice and easy. And I know you get this liquidity bull here, but, with day trading, you really don't want to aim for more than the 3 to 1. I mean, I'm a swing trader, and I aim for a 3 to 1 as well. Like, the higher the risk reward, the lower the probability. Everyone knows that. So, yeah, you get a 4 to 1 in this case, but, a lot of the time, you're going to get something like this, where you enter price, let's say you're up 3%, price starts to consolidate like that, or even starts reversing. I mean, just look at this, right? Look at this, instant reversal. So, always take the low-hanging fruit when it comes to trading. Always take the low-hanging fruit and be grateful for whatever profit the market gives you. And yeah, that's all you really need for this strategy. This is such a great strategy. You can fit it around work or studies, and you literally only need to check the charts every 15 minutes during your session, just to wait for a new candle to print. And yeah, that's as easy as I can make trading. The first thing you want to do is get on the 15-minute chart, zoom out, and look for the trend, right? Make sure you're on the right side of the market. Then you wait for your liquidity sweep. Always wait for liquidity sweep. Then you want a fair value gap that's in the buyer's direction, in the same trend as the higher time frame, or in this case, the 15-minute trend. And then you just enter on the fair value gap and you target a 2 or 3 risk to reward ratio. That's simple. That's all you need to be a profitable trader. Also, very quickly, I'm excited to announce that I've just released my brand new course, and I've spent months working on it, and trust me, it's a good one. And it teaches you everything you need to know to become a profitable trader, from beginner to pro. Everything you need: journaling, backtesting, 10 different entry models. It's everything I know packaged up. And if that sounds like something you're interested in, there's a link in the description below. But other than that, I hope you liked the video, and please like, subscribe, leave a comment for the algorithm, and I'll see you guys in the next video. Peace.